Alright, it's Sunday, June 3rd. This update is going to cover several world equity markets. And what I'm going to go through is several ETFs, foreign market ETFs, so you can understand what's going on there and understand if you have a hard time believing that the stock market could decline 80% off of the highs of this year. I have a hard time believing that too, but there are some chart patterns suggesting very bearish implications for the upcoming months or years around the world. So let's take a look at some of these. This first chart, this is Australia, and this is EWA, the equity ETF. This is the bear market from 2007 to 2009. Saw a nice rally, and what's possibly happening here is a pretty classic head and shoulders type of pattern. I know it's not at a new all-time high. This was a pretty pure, clean head and shoulders pattern here at the all-time high of the last bear market. Fulfilled a nice price objective down on that. So the way to measure these is you take the head to the neckline, project that down from where it breaks the neckline as a minimum target. A lot of times they'll exceed that by a significant portion there. So what I've done is just that on this level. I've taken the head to the potential neckline through here and projected that just down. Let's say we break that in the coming month or so here. That would project down back towards the bear market lows of 2009. 20 there, down to, let's say, 12. So potentially 40%, another 40% decline in the markets from these levels. Now Australia is a commodity intensive nation there as far as how that relates to world markets and exchanges and everything. So that would imply weakening commodities certainly for a coming period of time. If you look at this relative to the U.S. markets, this was the early late April 2011 where we saw our U.S. market top last year, and we had a dramatic decline into October of that year. But then remember, our markets advanced into new highs into January and February of 2012. So by this time here, our markets were at new highs above those highs. This market never even got above the October 2011 rebound. So relative to our market, it's very, very weak. So on that basis, it did not confirm the U.S. markets. You'd expect it to be in a weaker position even than our markets are. That's similar across the board for many commodity intensive markets. This is the Canadian stock market, pretty similar to the Australian market. A potential head and shoulders pattern down here projects back towards the 2009 lows. Again, this was the April 2011 highs. We missed that by a long shot. As our markets were making new highs, this didn't even retrace, I don't even think, 61.8% of that initial decline into October there. So those markets are in a very weak position there. We don't have confirmation yet of a completed head and shoulders pattern, so the market has not broken that neckline. But what is very typical is the market will come down, will break the neckline, will briefly retest the neckline, and then will fall apart after that. So we may get a rebound here before that neckline breaks, but what I would look for is any type of rebound to be a seller of that, and only short-term traders who are going to take protective stops be willing to go long at any point here. This chart is the German stock market, so this is EWG, and I had posted this on the blog a week or so ago, showing just a beautiful classic Elliott wave pattern here, a potential wave 1, 2, 3, 4, 5 type of pattern down, and then an ABC up, and then a potential 1, 2, 3, 4, 5 down with another potential ABC up. So we would be looking at a third wave down here, similar to a third wave of this degree down here. Third waves are very, very dramatic in pattern terms or Elliott wave terms. So we may be getting towards the middle of that, which is where you will tend to see the most vertical price movement and large gap downs and that type of thing. So we may be a few weeks, couple months off of seeing that type of movement, but that's possible at this time. What I've done here is you could conceive of this as a head and shoulders pattern too. I know it's not classic, but based on the underlying principle of how markets move, that's what this projection is here, is the head to neckline pattern projected down from the neckline. And if you look at this price channel as potentially a longer term flat type of pattern, like an ABC pattern, that would project right down towards the bottom channel line there, which would be about the minimum you'd expect a pattern like this to go to. In a case like this, I think it's very likely to overshoot that bottom channel line, but that would be about the minimum you would expect there. I'll briefly click over to a daily time frame here. If you look at the movement down off of the spring highs here as possibly a wave 1 and a wave 2, there's been no indication on the technical analysis that this potential wave 3 here down is complete. So what we may expect is a rebound into these levels for a wave 3, a wave 4 and wave 5. Possibly another rebound up into those levels before you really get into the meat of that wave 3 there. So a wave 3 to 3 of to speak of in Elliott wave terms. This next chart is Hong Kong, so EWH, and again what I've shown here is a support line similar to a head and shoulder support line, so you could project a projection down here that will put you back near the 2008-2009 lows. Again, it did not confirm new highs relative to 2011. So in 2010, this market actually peaked for its bull market. It made lower highs in 2011, where our markets were peaking in 2011. And then again, our markets peaked in the spring of 2012 here, and this market has continued to make lower highs. So it's in a very relatively weak position to some of our Western markets. So this market will likely be in a dramatically weak position in upcoming months and years. This is Italy, EWI. It's just a stone's throw away from the 2009 bear market lows. I think everybody has probably heard in the news of problems in Italy and Spain and some of those countries there. So while you might look at this and say, hey, this looks like a good time to buy this, like maybe there's some technical bullish divergence showing up at this point in time here, maybe even a wedge type of pattern, that could be the case. But anytime you see such dramatic relative weakness in a market, it's a trying to catch a falling knife type of a scenario. Here is the April and May 2011, where our markets peaked out last year, and our markets were at new highs as of the spring of this year, and this market barely even had a gasp of a recovery and is already at lows near the 2009 bear market lows. So this isn't a market that I would suggest trying to buy. I think it's in a very, very weak position. If our markets could potentially decline another 50 or 60%, what do you think these markets are going to do? These ones are the laggards. They're the weak ones. They may bottom before ours, but until they bottom, they're going to tend to be the weak hands. This is Japan. Again, Japan did not make new highs this year in 2012 relative to 2010 and 11, so it's in a weak position as well. This is Spain. Spain has just been getting killed. It's already below the 2009 bear market lows after a contraction type of a pattern. Broke that pattern, retested the trend line, and has just fallen apart here. So if you look at this in Elliott wave terms as a 1, 2, 3, 4, 5 with a triangle type of pattern, let's project the decline down from the break of the pattern there. That would put this market much, much lower. So down to 12 off of a high of around 70 in 2007. That's a very big decline. So again, some of these markets are in very, very weak positions, and I think are something to look to short on rebounds as opposed to trying to do any type of long trades other than very short-term trades. This is France. This is EWQ pattern. It's basically back at the October 2011 lows. So again, the markets are set for a possible rebound here, but what I would look for is maybe this breaking to new lows here over the next week or so, and then rebounding back into this support level at these lows here. So maybe the market breaks that and rallies back into this general area as a nice new daily time frame short entry. This is Singapore, showing a pretty nice weekly pattern. Again, not confirming new highs in 2012 relative to some of the other world markets. So same logic applies here. Maybe it's set for a rebound for a few weeks, but that would be a great time where it might be entering the middle of the potentially fastest part down. So if you look at this as a wave A or wave 1, and then a wave B or wave 2, this could be a wave 1 and a potentially small rebound for wave 2, and then you'd be entering wave 3 of this next decline down. So wave 3 of 3 or wave 3 of C, those tend to be very, very dramatic declines in Elliott wave terms. Those are times where if you see the market do this and rebound here, you buy some out of the money options. Several months out, you could end up with just a dramatic windfall profit on those type of options. So sometimes you can get 10, 20, 30, 40 fold increases, not percent. We're talking 1,000, 2,000, 3,000, 4,000% increase in those options if you time those nicely and really think those through. So if we do get a rebound like that in the world markets, I will definitely suggest some possibilities on those type of trades. This is United Kingdom, so Great Britain here, EWU. Similar pattern off the 2000 lows as our market pattern, where you have a dramatic initial thrust up as a possible A wave. You have a correction, you have a shorter wave C, then wave A, and then you have an even shorter wave E, then wave C. This wave E ends with a contraction type of a pattern. Again, it does not confirm new highs in 2012 relative to 2011 like our markets did. So a lot of these other markets around the world are relatively weak to ours. So makes us feel good about our markets, but if our markets are in a potentially very, very weak position, then what's going to happen to these other markets is they're going to get absolutely destroyed over the upcoming years. So this next one is South Korea. Just a really, really pretty pattern here. 1, 2, 3, 4, 5 down, ABC up, a tight harmonic resistance zone there. This line projects this decline down from the high of that ABC pattern. So you'd be looking at as a minimum. This projects the head and shoulders typical projection down from there. On a harmonic basis, this initial decline occurs at the 50% retracement of the entire bull market. In those cases, the market has two targets. The most commonly known harmonic pattern is called the bat pattern, where this 50% retracement, if you look at this as an ABC type of pattern, the next decline will come down to the 88.6% retracement. So in a bullish scenario, if the market declines below that low, that would be the level to look at. Now, the other one that I've noticed repetitively in many markets is if this decline occurs at the 50% level, sometimes the market will reverse at the 70.7% retracement level, which would be approximately in here, in the middle of these targets here. So you could use a weekly or monthly chart when that gets oversold. If you saw some type of divergence develop between a dramatic low, a rebound attempt, and then a lower low, and you saw a nice bullish divergence on those time frames, you could potentially look long at those points in time. This is Brazil, EWZ. Brazil is also a commodity intensive market, and it's been very, very weak here. It peaked 2009. It barely made a new high in 2010. Did not make new highs in 2011, as our market made new highs in 2012, is well below those 2010 and 11 highs, and then it's just been getting killed here this spring so far in 2012. You could look at this as a potential head and shoulders with a support type of line here with a low right shoulder. Again, project down from wherever that breaks the low would take us back near the 2008-2009 lows in Brazil. So the take-home message from this is there's some relatively standard, pretty chart patterns, head and shoulders patterns, and harmonic patterns and ABC type of patterns that really point to some continuing very dramatic declines in the world markets. Our market, U.S. market, is stronger than the world markets. They have not confirmed our new highs. When you're seeing non-confirmations like that all around the world, that's just a telltale sign that these markets are headed lower. So if you have any doubt about whether this is bull market or bear market, my money is on definitely the tide turning down in the markets all around the world there, and we should see lower prices over the next few years, probably dramatically so. This may be probably the biggest decline that any of us will see in our lifetime who's listening to this. So the good news on that is if you're out and you're safe and the world doesn't implode, then you potentially have the buying opportunity of a lifetime a couple years down the road, where you may be set for several 100% returns in the years or decades to follow, if you can have the guts to buy into a market that looks like it's going to go to zero at some point a couple years down the road. So that's kind of a big picture outlook on some of these, but I did mention that I was going to try and do that here a week or so ago, look at some of these markets. If looking for new shorts here in upcoming weeks, what I would look at is I would look at these weaker markets, these commodity intensive markets like Brazil, like Canada, like Australia, some of those markets I showed. Those are the weak-handed ones. You may even look at the Italys or the Spains. Those look so oversold already that those aren't good to short, but if they do continue to fall, they'll probably enter an extremely vertical waterfall type of decline at some point here in the next few months. And those are the type of moves that are just breathtaking, but you can make a large amount of money on in a relatively short period of time. So that's all for this update. I may try to make a video showing what's going on in the bond market. What I think is this is a last gasp up in the U.S. bond market, and we may see, as the next phase of crisis in the world markets as that unfolds, is we may see bond prices just get hammered and interest rates start to really poke up and then spike up over the next coming months and coming years. I think I could make a very, very strong case for that happening on a number of different levels. So hopefully I'll get that out here at some point, either this weekend or in the next coming weeks, as we potentially see that market start to reverse to the downside. So that's all for this update. Have a great weekend.